Okay, can you hear me all right? All good? All right, so before we start like all the investing one-on-one sessions, we just want to like kind of review the basics to get a good mental framework and yeah, how to approach investing and financial markets. All right, so kind of an obvious question, but why would people invest? Well, you can make money, you can grow your capital. It's a good way to kind of make money more passively because once you place your money, you don't really have to work for it. So it's a good, like it's another source of income that is very important to develop. And why should you develop it? Because you can hedge against inflation. And inflation, basically, it's like an economic process that makes your currency devalue. Like your money is worth less every year. And by investing, basically what you want to do is kind of like, so basically if inflation is like 2% every year, your capital will decrease by 2%. And basically by investing, what you want to do is get over those 2% and thus not losing any money. All right, so how do we invest? First, you need to choose an asset class. This is very important because depending on what you choose, the whole process will be different. Usually, like we'll put like real estate in one place and equities, so everything that's related to like stocks, companies, ETFs, index funds, Forex, so foreign currencies, cryptocurrencies, commodities, like in another place, because for like real estate, it's a whole different story. It's very different than like how you would approach buying shares or buying cryptocurrencies. So once you decided, okay, I want to invest in this or in that, you have to get in touch with an exchange or a broker. So basically an exchange is a place where you can buy and sell your assets. For like stocks, you have interactive brokers, Fidelity. For cryptocurrencies, you have like things like Coinbase, Binance, FTX, all of that. And then once you have all of that, you have all the tools, you buy and sell your assets. Very simple. So usually like you don't really have to go rogue with like a broker, find something else than your bank. Sometimes banks do have the service that you can invest with them, might not be as, you might have like less advantages than with like an exchange or a broker. It depends. So yeah, just for like the definitions, the exchange is the place where you can buy and sell assets. That can be a website, whatever. The broker can also be a website. Sometimes it's actually like someone that will help you make transactions for you if you don't want to like deal with all like the technical aspects of the website. But it's usually kind of the same thing, except the broker is an actual person that makes the trades for you. All right, so your approach in the, like how you approach investing and financial markets is actually very important. So you have to ask yourself the right questions and you have to get the right knowledge to make the best decisions because investing is a risk. So risk is the most important variable that you need to understand once you approach financial markets. And everyone in finance is battling to kind of understand it, to control it. When you have banks, they will pay people a lot of money if they can understand risk and how to like diminish it. The problem is for retail investors, so for like normal people, this is sometimes very overlooked. And by understanding risk, you can actually ask yourself the question, how risky am I willing to get? How much am I willing to lose? By answering this question, you can then define like certain assets that you want to invest in. If you don't want any risk, you just want like your money to grow very slowly without any downsides, maybe you should avoid cryptocurrencies. Some people would say they're risky and it's not a good investment if you want to be very risk neutral. And to answer this question, you have to understand kind of, and to avoid all the scams online, you have to understand the relationship between risk and reward. Okay, so usually an investment that will produce like good reward and good rewards and will have like a lot of upsides usually will come with more risk. Okay, and sometimes people will try to sell you like opportunities which are like high reward and low risk. Basically, all of this zone is kind of a unicorn. It doesn't exist. If you have one, like well done. You can take advantage of it. But yeah, you have to understand the risk carefully, because once you know exactly how risky you're going to get, this will impact how much you need to know, how much effort you need to put in your investing journey, okay? And it's very important also when you choose your asset classes to understand that some asset classes, yeah, they're more risky. You will need different knowledge to understand them. And yeah, you need to figure this one out. How much am I willing to lose? Because if you invest a lot of money and everything crashes, am I able to take it? If everything crashes, will I still make a smart decision? Okay, so once you've kind of answered these questions, I thought it was kind of important to show the differences between investing and trading, because sometimes online people say, I'm an investor, I'm a trader. What's the difference? Who is losing at this game? Okay. So usually investing is associated with long-term, low risk and capital allocations. I'll use investing again. So usually it's when you will buy and hold assets, very boring. The goal is to buy low, sell high, you will wait. Returns will be kind of slow or good if you're a very good investor. But usually, yeah, people when they invest, like the normal people that don't want high risks, they buy index funds, they'll buy stocks, and they'll be good with the returns they make. And when you do investing, usually you don't really care about how the price is moving at a certain extent. You don't care about charts and all the movements that happens with the prices. Usually you will just do some type of fundamental analysis. If you want to invest in a company, look at what the business is doing. Is it making money? Is it successful? And yeah, or usually you will care about how the economy is doing, but you don't care about you won't look at charts and be like, oh yeah, we're at suppose resistance, some sort of pattern, none of that. When you do trading is associated with short-term, high-risk behaviors, all right? It's when you trying to maximize your returns by chasing trends, okay? So let's say, all right, tell me if you don't really, you can't really see it. Let's say the stock price, let's say it will go up, will go down, go up again, down, up. As an investor, let's say you buy this, the stock here, you sell it here. Thing is, you will make some return because the price has obviously gone up. You'll make the difference between this level and this level. And the trader, what he's going to do is he's going to be like, well, okay, here I made money on this path right here. But then I kind of lost some of these gains because the price crashed down. And here again until the end point. So he's like, what if I didn't just buy and hold and trying to be more cool and buy here and sell here? And then maybe wait for the crash, buy again, sell again, buy again, sell again. And so this, in theory, is very good. So a lot of people go into trading because they're like, I mean, it's not very complicated. Once I look at this chart, yeah, I can see what kind of strategy I should use. But it's very risky to kind of time all of this. In fact, if you look at a company, maybe you can predict in large timescales what the price is going to do. If the new trend is electric vehicles and you have a president that likes electric vehicles and he's elected, yeah, maybe if you pick an electric vehicle company and it's good, you can say over the next 5 years, the price is going to move. The thing is, the more you shorten this time scale, the harder it becomes. And people are trying all the time to say they have trading strategies and they can time the market, and it's very hard. Okay, retail traders, usually they don't make it. And traders usually, instead of when investing, you buy an asset, you hold it, then you sell it. Traders, they have this thing called shorting. So when I say long and short positions, when you go long on an asset, it's usually you're betting that the price will grow. So it's kind of like buying and then selling the asset. It depends depends on a lot of things, but usually it's that. When you're shorting an asset, we can get into it. Like if you want me to explain how shorting works after the presentation, we can. But usually, like just for the sake of it, it's betting that the market will go south. So if the markets go down, you're good. You make money, right? So that's shorting. So a trader will be like long, short, long, short, long, short, enormous gains. However, it requires a lot of effort, and it's usually very risky, and not a lot of people can do it. Okay, so now we're gonna talk still on the approach. So once you've decided, how much risk do I want to put in? How deep do I want to get into investing? Some people, they don't care about finance. They just want to focus on the jobs and just have some money grow on the side. Now you need to improve your knowledge. Basically, the more you know, the better you will invest. It's not it's kind of a oversimplification because there is a lot of outside noise, a lot of information that you'll find online is not that good. So you need to kind of filter out, and you need to have your vision clear about what you're looking for. And everything knowledge, once you assess your risk, the knowledge that you need to know to invest good, people say, do your own research, educate yourself before invest. Okay, but how far do I need to go? What should I know? Well, this depends on your goals and preferences. If you don't want to spend too much time on it, you probably don't need as much knowledge as if you want to trade or you want investing to be a job. And also the knowledge that you will need will depend on the asset class. So first, I'll explain that in a bit. First, I think for investing, you should have a basic understanding of how the economy works, because how a country runs itself, the president that you have, the people that he puts in place that control the money supply and make the big decisions will impact asset prices, even if it's a very small company. So if you have a kind of a basic understanding of how the economy works, it should be good. If you understand how inflation works, how the Federal Reserve works, like central banks and all of that, which leads, you should also have a good understanding of how the financial industry works, because you want to know, again, you want to know who moves the market and how they do it, why they do it this way. And once you understand that, it's a bit of game theory where you have all the players, you understand what the goals are, what the practices is, how they think. And if you can integrate that in your strategies, it's better, because then you know how to navigate all this crap, Then business, if you want to invest in a company, you don't understand what the business does. It's kind of a lost cause. So you have to if you want to invest in equities, it's good to know when you see a business, to see if it has an edge over the competition, to understand what it offers, how it's running itself, and to kind of determine if it's a good investment. And usually with understanding of a business, this is probably the most boring part of it, but financial accounting is pretty good to know, understand how cash flow, how businesses make money, how they manage the money, cash flows, how much debt they have, to understand their balance sheets. You go through the 10Ks, which is basically the holy grail of financial documents, where you have all the business exposed. They tell you everything there is you need to know, basically. So again, depending on what you want to know, you don't have to go very far in those fields. But if you want to be good at investing, if that's really your goal, that's what you have to do. A lot of people, they don't care about financial accounting, but it's very important to be able to read 10Ks. It's very, people, they will analyze through hundreds of stocks on their own. Who wants to do that? Not a lot of people. However, that's what it takes. You have to look at how the big players in the industry works. When you see a hedge fund that's outperforming the market, they don't do that because they've seen someone on social media talk about a stock. It's because they have teams of analysts going through stocks and analyzing them and making predictions, understanding how they work to the core. They know everyone that is in the business that runs it. They know their behaviors. They know how these people work. And also, yeah, based on your asset classes, this will kind of change. If you want to go in real estate, business, yeah, I mean, you might have some use to it, but if you want to buy a house, it's not really like a business. So you see, it depends on the asset class. For example, if you want to invest in currencies, economy is very important to understand, and also like how the central banks work, because usually like the price of a currency in Forex, if there is a new president, it will change. If you want to invest in equities, really like, yeah, I mean, you can't miss one, but yes, if you choose certain asset classes, you will have to focus on some of them more than the others. Yeah, so I explained it. All right, so what is it like? Obviously, it's important to kind of trust yourself and to do your own research, because you can't be dependent on someone else. It's not like avoid any like exterior advice. This is not the goal. Basically, if someone comes to you, the goal is if someone comes to you, you see on social media saying, this is a good investment, you should invest in this, and they give you their reasons, you should be able to say, okay, so I kind of have an understanding of the field he's talking about. Let's see if he's bullshitting us. That's the question. Every time you see financial information, you have to ask yourself, BS or not, okay? So be careful of your sources when you go into investing, because there is a lot of outside noise. You would be like, even if it's investment banks or hedge funds giving our reports on stocks, their predictions, be careful when you read them, because it might be just marketing for the stocks. Like if an investment bank could say like, oh yeah, there is this new company in this new sector, very exciting, very good fundamentals. I mean, you never know, maybe they have new financial instruments coming for this product. So don't trust anyone. I mean, if someone has a lot of experience, still like consider what they're saying, but your goal is to be confident when you see something, to be like, yeah, I want to invest in it because I understand the investment. I understand why this person is saying this is a good investment, invest in it. All right, so we talked about like the financial industry. So we're gonna kind of like focus on it, especially like if you people that choose trading, they kind of like this framework where it's like a battle. It's retail investors versus institutions. People that think the price will go up versus people that think the price will go down. And if you understand how the big players in finance work and kind of how they move the markets, it's a good thing, because then you won't be taken by surprise if you don't understand how the central banks work and how investment banks are linked with central banks and hedge funds, what they want. And because these people move things. So if they want a certain thing, there's a good chance that they will have it. By understanding how they work and what they want, it's just better for like to understand what's happening in the markets, because if you understand what happens in the markets, you can make better predictions in a sense. So yeah, we can categorize all these firms multiple ways. Simplest way is you have the buy and sell side. The buy side is the people that will buy and invest in financial instruments. All right, I put retail investors, technically not a firm, but if you think about it, they buy, like we buy stocks, we buy assets. So I just put them in there to categorize them. So yeah, in buy side, they actually take position. They care about where the market goes. So you have hedge funds, mutual funds, all type of funds that you can think of, asset managers that take care of people's money, private equity firms, VC firms, all of them, okay? And then you have the sell side. So the sell side, they create, they produce, and they sell those financial instruments. So you have investment banks, market makers, investment banks are kind of market makers, but I mean, it depends on the firms, kind of get really complicated very quickly. You have brokers. I put research companies, technically, they kind of sell research that the buy side will then use to make those investments. So we kind of like debate if they really have their spot on the sell side or if they just like not even on one of those sides. Yeah, the goal is to provide liquidity. So their goal is for these guys to buy whatever they are selling. Okay, so that's why I told you should be careful when the sell side is pitching you something. You have to remember at some point they still like they want people to buy those financial products, so they will market those financial products if they can. I mean, investment banks usually they will like do their own trading, so sometimes they will swing by, but in essence, investment bank is on the sell side. And so all of these companies kind of hard to understand exactly what they are. However, on Thursday, we'll have a career one-on-one session where we'll like go into details on what they do, what kind of opportunities, if you want to work in finance, because a lot of them will share names for positions, but it's like a different thing. It gets really complicated. There's not a lot of information on it if you just Google it. I mean, there is, but it's still kind of complicated. So yeah, come on Thursday if you want to know how they work and what you can do with them. So yeah, basically, this very beautiful image is to represent like this kind of framework that people have where it's retail investors versus the institutions, little fish vs the whale. So usually this analogy is used by people who are trading, and it's good to remind it for like people that want to go and compete. Like it's kind of like a battle. It's yeah, retail investors versus institutions. People like the retail side will say, "Oh yeah, institutions, they're always trying to steal our money. We get liquidated, like we get liquidations and all of that." And if you decide to go into trading, if you really want to like, if you want to like overcome all the benchmarks, you want to be better than the S&P, you want to like yeah make actual money, and you don't want to wait for compound interest to kick in. You have to understand that these institutions, they are like on steroids, all right? They have teams of analysts, they have machine learning tools, that they have like new strategies that will change every few months on how to pick stocks and how to predict where the prices will go. So be careful of what people tell you, all right? What people will sell you on the internet, because usually those strategies that they use, if they would work, hedge funds would not hire like PhD students in like mathematical finance to create strategies, all right? So yep, in summary, yeah, if you want like to kind of kickstart your investing journey, define your goals and your risk tolerance. Be clear on what you want, because you don't want to fall in this kind of behavior. Like if you invest in crypto, you always see, you have friends telling you, "Oh man, I bought crypto, but I lost everything. I'm so bad. This is like a scam." It's because people, they don't understand the risk that they take. All right, if you're going to take a risk, you're betting on something. You're betting that yeah, it will go up. However, it's a risky bet to kind of understand how markets move. So if you define your goals and your risk tolerance, then go educate yourself. Learn like the basics of investing. See how far you want to go. Like be thorough with yourself, because you don't want to lose all your money because one like stupid bet. All right, people, they will get greedy and they will like start trading maybe with leverage. They'll like borrow money to trade, or like they will invest into some risky stuff because they're not educated, because they let the greed take over them. And yeah, avoid impulsive decisions. Happens to everyone, happens to me like way too often, where you see like I'm all in on crypto, right? So when it crashes, sometimes I sell, sometimes I don't. Bad decision, good decisions, yeah, avoid it. You have to be strong, intelligent about what you do, and everything should be fine. If you understand all that's happening to you and you're not trusting some shady guy on Twitter, you should be fine, okay? And lastly, just to finish, some resources that I think are very good. I mean, this is like a drop in the ocean, but yeah, do the Bloomberg market concept. It's free if you're with the uni. It's very good. You have basic understanding on multiple markets, currencies, equities, fixed income, so like bonds, debt, very interesting. And yeah, it's good if you want to develop kind of to see how the economy works at certain extent and how the different financial institutions are linked together. If you want to watch something on YouTube, this video, How the Economic Machine Works by Ray Dalio, which is like the biggest hedge fund manager. I think he has like one of the biggest hedge funds, legendary investor. He did like, I think it's like 30 minutes, between 20 and 40. Incredible. He explains how the economy works, simple terms. You have, yeah, it's very good to kind of get a grasp of what's happening. And when you turn on the news and you see people yapping about all these indicators, and debt and inflation and who are we losing money, you kind of see what's happening. Then books. Yeah, I mean, books, you have a lot of them. You have Intelligent Investor, the little book of common sense investing, Thinking Fast and Slow. All these books, very good. If you want to read, if you want to get good at financial markets, read about how, like the psychology behind financial markets, you know, pinpoint what you want to learn about, find books about it. But be critical even of books because it's not absolute knowledge.